Good morning and welcome to Master Trader, where you can learn to use simple market and stock analysis to make money investing and trading. I'm Greg Capper. Today I'm going to show you the breakdown bar failure pattern. So a few months ago, I showed you the breakout bar failure pattern when this was occurring up at the high here, which suggested a short-term pullback. Did not suggest the drop that we did see. Now, on Monday, the 2nd, prices, the S&P, the Dow, they broke down below their 200 period moving average. It was a big down day, and every commentator that there was on CNBC, probably whatever you were reading out there on internet blogs and so on, talked about the break of the 200 period moving average and how that implied lower prices. You saw the technicians pulling out their drawing tools, connecting the dots, showing breaks of uptrend lines and predicting lower prices. At Master Trader, we were telling subscribers on that night, this is setting up, in all likelihood, to be a breakdown bar failure. I explained what had to set up for that to happen. Now, as I've coined the market as of late because of this erratic type of price action, Mr. Schizophrenic, yesterday's news on the potential trade tariff wars threw a little bit of a monkey wrench into the setup, and we had this initial gap down. And you don't see that because of the 24-hour chart, but if we were to go to another time frame, you would see that gap down. I say another instrument. But prices rallied from that move lower, and they moved higher all day. So the fear and the selling that occurred first thing in the morning evaporated instantly, and buyers stepped up, and that completed the breakdown bar failure with a little bit of a twist to it because of the news. Now, what I've told subscribers is that when this sets up, we're going to expect higher prices, and we put on a lot of positions yesterday, bullish positions, and we're looking for those prices to continue to go higher. Now, at this point, odds are prices are going to stall up in this area, and a lot of times after a big, wide day like that we have today, you do get a period of consolidation, usually a day, maybe two. So we'll see what happens into the end of the week. However, at this point, let's look at the hourly chart right now. You've got this move up into this area of resistance, and we may have a little mini breakout failure right there. But we'll continue to the higher time frames now. Go and read this week's chart of the week that I put out last night with the video explaining the pattern and what I told subscribers. It's a free service. You can subscribe to it or just go to the site and click on it and read it. I'm sure you'll find it educational, and you'll pick up a few tidbits there of what I explained about the pattern. So now let's just go to the spiders. Better yet, let's look at the Dow. Everybody talks about the Dow, but you can see the pattern there in the spiders and the gap down that occurred yesterday, and then the big reversal rally day. Now, in the Dow, you had this little poke, but it didn't close under the 200, but this pattern sets up with a minor bottoming tail, meaning it's not a complete bottoming tail because the prices don't close more than halfway into the range. But I want to show you the weekly chart, what I told subscribers on Monday's letter, that this was potentially going to set up a W type of a bottom here. And then when I saw the down day on Monday, I was like, this is what we're looking for. If you're a subscriber, go back and look at Monday's letter, read the commentary. So now, assuming that the market holds up, and I assume that it will, we're going to close this week with a bottoming tail bar right here. Now, we've got a lot of overhead resistance to deal with over here, so odds are it's going to be choppy type of price action to get through it, but this does open up the door to moving up to the old highs. So let's take a look at why I had a bias of prices forming that breakdown bar failure, because prices in of itself are one starting point, and it's these market internals that guide us as to the probability of certain patterns occurring and beginning to assume, if you will, that they're going to happen before they've even happened. So these market internals, we had sentiment that was extremely bullish, we had breadth that was bullish, and prices were diverging, or the breadth was diverging, meaning we were getting a higher low in the breadth where prices were pushing down and actually making a new closing low over here, and breadth was making a higher low. So there was some internal strength within the market. What we look for with these internals is alignment or agreement between sentiment and breadth. One without the other does not provide us a signal. So now that we've got that signal, we've got a bullish pattern that's formed here, we just manage our positions accordingly. Of course, we're looking for that stall, and there'll probably be a stall up here. And, there are those that follow these moving averages. And so, point being, when you have this alignment where prices have trended down and you start to get bullish patterns and market internals and higher time frames, as we do over here, that are turning bullish, it takes a little time for prices to work their way through the supply overhead. So that's what you should be looking for going into the next several weeks. And we have new lines in the sand, meaning these areas down here should not be violated. Ideally, this big wide range bar, as I explained in the chart of the week, any pullback in the next few days should stay in the upper half of that wide range bar. These are all master trader technical strategies taught in that course. We use many option strategies to take advantage of these price patterns. Go to Master Trader, check out that chart of the week. It's a free service. You'll learn a tremendous amount there, and then you consider joining and taking one of our classes and becoming a master trader yourself. Good trading, everyone.